Hi, Steve Van Metre here, and welcome to your weekly economic update, where we take about 30 minutes on every Friday to take a deeper dive into the economic data, try to make some sense of it. Of course, a lot of it really doesn't make much sense right now because we keep seeing stock prices rise and economic data fall, and usually you don't see that kind of divergence. Usually stock prices follow economic data, which suggests stock prices should be a lot lower than they are now. But there's been a lot of hope pinned on a trade deal between the United States and China, one that we started. It's interesting that we could start a trade war that the stock market deems as bullish. And as it comes to potential conclusion, who knows in the months, maybe years to come, that the ongoing saga of it is bullish for stock prices as well. So much has been baked into this cake that it makes you wonder if it could even deliver once it's passed. If of course, once it's struck, then of course, does Congress approve it? Who knows? But yet, everybody thinks that a trade deal is inflationary, which means a trade tariff, which we're now, has to be disinflationary, but yet the market thinks that's inflationary too. So how can it be inflationary across the board? Well, it can't. And that's kind of the idea behind this week's update. At least the written part, which if you haven't read it yet, I'm sure you will soon, it simply says that a trade war is not inflationary at all, because the definition of inflation it is an expansion of the money supply, which is what it really is, but the markets and the Fed interpret it as a rise in consumer prices or factory prices. Either one, we're called producer prices, either one works. Well, tariffs raise prices. And that's not disinflationary. In fact, I'd argue, according to the Fed's definition, that is inflation. Now, it's not actually inflation. It just means prices are rising, and anybody can raise their price for any reason. And that doesn't necessarily turn into inflation. But again, if your benchmark is a rise in prices, yes, well, that would be inflationary. So the idea that when these tariffs are removed, presumably when a deal is struck, how's that going to trigger inflation? Well, it can't. It's actually going to have the opposite effect because prices are going to fall, and that's disinflationary. So you see, it kind of doesn't make a lot of sense as to what everyone's so focused on, this big reflation of the global economy and how a self-imposed trade deal could be bullish on both ends of the story. I've said before, and I'll say again, if that's the case, then we should go start trade wars with everybody, and then when they're completed, we should do it again. Maybe stocks will go up indefinitely if we just tariff everybody, promise to remove them, and then re-tariff them. Seems like a good recipe for me. But nevertheless, the whole idea is that the trade war is not inflationary. The belief then is that, prices fall, consumers have more money to spend on other stuff. And the reality is, if you look at the growth rate of the money supply, which we do every week, you realize that consumers really don't have excess money because the money supply is growing at about a third of its long-term rate. Now, the real topic of today's update is, can the market go higher? In fact, I think that's going to be our overlying theme for the rest of our video here today, is how much higher can the market really go, or does it need to have a correction before it can make potentially new highs? Well, let's see if we can answer that. Before we do, the content of this video is provided as educational information only, is not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation to buy or selling security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre, my own personal capacity. The opinions expressed in the video that I own do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. So, can the market go higher? Well, it can always go higher. But let's run through some of the data and see if it makes a whole lot of sense. All right, starting out, the money supply is up to 4.21%. I think I may have mentioned earlier this week to expect an increase in the money supply because we're seeing a dip in the data from 12/6 and not quite 3 months ago, but for definitely in the 12-month and the 6-month range, there was a bit of a dip. And we saw the M2 grow by $25 billion to $588 billion over last week. And so that is definitely helping propel the 12-month growth rate up to 4.21%. It was just down to just about 4 last week. Now, the 6-month rate of change is at 2.33 and rising, which would suggest that this is headed higher to over 4.5%. Whether that'll play out or not, I'm not sure, because the 3-month rate of change is still telling us that we're looking at around 0.7. Punch this in my calculator as we speak, is about 3.5%. So there's a little bit of noise in the data, which one is right and which one is wrong. Hard to say at this moment. But still, on the long-term average, growth rate is about 6.5%. So we're still running a third of our normal level. Should put GDP growth around 2% or less. This isn't a narrative for higher stock prices at all. It just means money is flowing into stocks where it could be going into the real economy. Commercial industrial loans on a year-over-year basis, and we didn't have any update from last week. I don't know why the Fed didn't post any charts. The growth rate is down to 8.2. I said eventually this will roll over, and it's pretty funny because a broken clock is right twice a day, so bingo, I'll take it. Anyway, so this is finally rolling over, and you can see it's hard to see here, but there's a pretty big drop. And from a year ago, the growth rate was 4.35%. And I've been saying as we run up this line here that the growth rate is going to roll over because there's just not a lot of strong lending growth going on in the markets. But this looked really good. It looked good. And this tells us, based on the relationship between commercial industrial lending and the US dollar, which I didn't put a chart up, that the dollar should be peaking and rolling over here at some point. And here's some more evidence of a contracting lending growth is credit cards and other revolving plans. Big drop down to 4.05% year over year. And as I've said, so goes the consumer, there goes the economy. And we saw this little uptrend here. And you kind of say, well, maybe this is mimicking the stock market. Well, if it is mimicking the stock market, this is an ominous sign for stock prices for sure. I'm not saying that's the case. I'm just saying that the consumer is not spending as much, and that should be alarming to people, but it doesn't seem to be. The Federal Reserve increased their balance sheet $1 billion last week, which is inconsequential. This will be the last full month of their unwind before they cut this back starting at the first of next month, and then they'll run this to the end of September where they will stop. We will talk about that more in the future. It's just not worth the trouble today. So as we try to answer some questions, is this a sign of higher stock prices? No, because consumers need to spend. Is this a sign? No, because corporations need to borrow. And is this a sign? Not really, because you want to see the money supply really growing to flow into stocks. Now, let's take a look at the buyback blackout period. We are right here, right now, April 12th. So you see the 14th is right in here. So here we are. 75% of the market is blacked out. And next week, we will hit 80%. So we will hit peak buyback blackout. Try to say that a few times in a row next week. And yet stock prices chug higher. And that's kind of interesting. And the reason that is interesting is not for the reasons people think, but I want to pull up, see if this will work. I'm going to load it in the other screen before I switch over to make sure it works. There we go. Now, we haven't used the site in a while because there was some problems with it keeping updated. And this is the percentage of S&P 500 stocks at 52-week highs. Let me make sure you can actually see this. Yep, okay. I've had a bad habit, for those of you who watched these videos in the past, of me getting on the wrong screen and babbling on for minutes on end, only for you to have no idea what I'm talking about. So this shows the percentage of S&P 500 stocks at 52-week highs. Back at the left would be our left shoulder in the potential head, left shoulder, right shoulder pattern. The percentage of stocks at their 52-week high was about 23%. So you can see over here at the next peak that fell to somewhere around 9 or 10%. And here we are at about 6. So you could you could frame this one of two ways. You could say, oh, wow, that's great. Not many stocks are at their 52-week high. So that means the market could go higher as more stocks reach their 52-week high. That would be your bullish view. The bearish view is 6% of stocks in the S&P 500, or 30 stocks, are driving the entire market. In fact, from a bearish view, you would say, well, there was more making their high here, and then there was more making their high here. So the trend is clearly lower. So a smaller number of stocks are driving the market, and that in itself is not bullish at all. All right, we'll clear that out of the way. Back to our buyback chart, and let's go on. And we can see global money supply, global M2 and central bank assets are contracting. According to this chart, the last time they did that was back in 2015, 2016, when we were facing a recession. And you can see it didn't even happen back in 2008 or 9. This is not a positive sign for the global economy. What this says, according to Crest Capital, is the amount of money created in the global economy is shrinking. So it's contracting. That means on a year-over-year basis, the amount of money in the global economy is falling. That is not bullish for asset prices at all. Now, this chart floated around from a couple people, so I grabbed it from Gonzo charts. I don't know who Gonzo is, but nevertheless, S&P 500 revenue per share versus a trade-weighted dollar. And it shows here that there is an 8-month lag between S&P 500 in terms of how much revenue it earns per each share against the trade-weighted dollar, which is inverted. So the dollar's been rising, so this is why it's showing it inverted. And what that says is on a revenue per share basis, the S&P 500 should be headed lower. When this revenue falls, well, so should stock prices. So this is not exactly pointing to a rosy outlook either. Let's look at earnings growth. This is the latest from FactSet. Negative earnings growth isn't deterring investors at all. In fact, people think this is a great time to buy stocks. And you can see the S&P 500 is expected, this is how close this is, from March 31st was at minus 4%. Today it's at a minus 4.2 on an annualized basis. Look at the energy sector there, and this makes no sense to me of why people are bidding oil prices and oil stocks up, because they're going to show a big negative earnings, should bring prices down. That's what we want to see. Buy low, sell high. And I still think this market in the energy sector is too high. But look at information technology, one of the biggest buyers of stocks. They're going to show negative growth. So are materials. These are like mining stocks. And so this is not a bullish outlook either. You normally don't see people buying falling earnings. Usually you want to buy rising earnings. Here's a chart of Apple against standard earnings per share on a GAAP basis. The GAAP is a government accountability standard for doing your earnings. And here we see Apple stock in black, and it's kind of just taken off out of nowhere, which is an indication of Apple being the largest buyer of stock. I think they're buying more stock than any other company out there is buying their stock back. And their earnings are projected to fall, which says their stock should be trading sub 100 instead of over 200 where it is today. I know a lot of Apple investors don't want to believe that, but that is the power of share buybacks, is when you have someone who is just buying at any price for any reason. Wait till Apple runs low on money and they stop doing this, so they cut this back. You can only imagine where their stock prices is heading. So Apple is trying to buy their stock up, and so are many other companies, and that is not long-term bullish. And the simple reason is there's not an indefinite amount of money the corporation is using to buy their stock back. There isn't. There never has been. There never will be. Well, I suppose there could be if the government just printed money. Percent of profitable firms in Russell 2000 index, which is the small cap index, 62.5% of small cap companies are profitable, yet there's a lot of money flowing into small caps. And you can see that when it gets down in these levels, well, the earnings per share expectations are way up here. Something doesn't make sense is how you have 60% of the firms are profitable, and yet they're supposed to be making a lot of money. Well, that means that earnings per share needs to fall. Again, share buybacks distort. Here you can see another evidence of stock buybacks. You can see 3-day new highs in the New York Stock Exchange, and here you can see it. There's declining, and stock prices are rising. This is corporate share buybacks still pushing the market higher. We don't know what they spent this first quarter, but it'll be really interesting. I bet they spent a lot more than anyone expected. But this is showing the number of new highs is falling, as we saw in the other chart. And this is not a bullish perspective at all. And you can see going back, new highs. See, we looked at this kind of in the S&P 500 chart. You see the new highs here, lower new highs here, and lower new highs here. Tells you the stock prices should be falling. Probably the best chart I found this last week is corporations are the largest source of equity demand according to the Federal Reserve and Goldman Sachs. And they were showing by year how much money corporations have bought, or stocks, corporations, how much money corporations have put into stock market, foreign investors, pension funds, mutual funds, households, life insurance, and other. So I added it up. And since 2014, the last 4 years, corporations have bought $2.45 trillion worth of stock. Foreign investors have been net sellers at the tune of about $234 billion. Pension funds, minus 901. They've been net sellers of equities. I'm going to add these up. I should have done this earlier, but I'm going to do it while we're going along. Mutual fund companies, minus 217 billion. Households, which everyone says is buying, selling 223 billion in stocks. Life insurance companies, they've been buying. They say, wait a minute, whoa, why are life insurance companies buying? Well, this is probably people buying stocks in their annuities or life insurance policies that have the provision to do that. So that isn't probably life insurance companies themselves buying it, but it's under the life insurance umbrella. And other, no idea what other is, but there has been net selling of $1.53 trillion over the last 4 years against corporations buying $2.45 trillion in stocks. So about $1 trillion in difference, or about 900 billion if you really want to be more specific, somewhere in there. And what does that tell us is simple. When the demand from corporates dries up, when they run out of money, when their earnings finally fall and their cash levels fall, and they stop or cut buying back stock, the largest buyer of stocks in the market is gone because everybody else is selling. And this is the proof that says people are selling over the last 4 years, and the only buyer is corporates. That money dries up, which it will. Who's going to buy stocks? And think about who's going to buy it, because how do stock prices rise? You know, think it's like an auction, right? You go to an auction, and how does the price rise? People bid the price up. Well, if there's no one buying because everyone else is selling, what's going to happen to stock prices? Way down. People don't believe that. But the only reason stock prices are as high as they are today, and the only reason they're staying as high as they are, is because corporations have bought almost $1 trillion more in stock over the last 4 years than has been sold. $1 trillion. And when that goes away, the market is going to plummet. And now you have the hard evidence, courtesy of Goldman Sachs. All right, so we will move on to the web browser. Let's switch over to that. All right, so we've seen Treasury yields tick up this week. It's mostly a speculative move. And according to the H.8 report, we see that banks have dropped about $3 billion in Treasuries, and insignificant, $4 billion in Treasuries, rather insignificant in the big picture, considering how much they bought. You can see that going back just to March of last year, so a year ago, they held about $2.5 trillion, and now they're $2.75 trillion. So that's a big increase in the number of treasuries. Mortgage-backed securities held pretty much the same, and then non-mortgage-backed securities dropped $3 billion. Again, insignificant when you consider we've gone, they bought $200 billion in non-mortgage-backed securities, and then they've bought just about $150 billion mortgage-backed securities. So banks are buying bonds. So everything you see is speculative in nature. All right, let's go on to the weather patterns. I want to touch on this when we do get to the ag commodities. We're seeing cooler weather hitting the farming region over the next 6 to 10 days. There is a bomb cyclone, which we can't see in the precipitation chart because this is the 6 to 10 day, and this is moving out of this region. I just spoke with someone in Colorado this morning, and she said, yeah, we just got hammered with this storm. And I said, that's the bomb cyclone. She goes, yes, that's what it is. And that is going to dump a monster amount of snow on the growing region, who is already flooded and doesn't need more snow and precipitation. And then you'll see it rolling across the United States here. So it's kind of right around in here, well, maybe right in here somewhere, but it's hitting this area really, really soon. Now, if we look out at the 8 to 14 day forecast, you can finally see some drier weather coming, but not after there's still above average precipitation hitting. And I'm sure the farmers will be relieved to see some drier weather coming. But according to the National Weather Service, there is more flooding to come. All right, and then I want to talk about gold. But before we do, let's go to the gold chart that I've got, and then we'll get into the broad market. And I just kind of want to get out of that browser, get everything cleared off my table there. So here is gold. Now, everybody knows I've been wanting to buy gold, and bottoms take a while. We know that this down move in here was due to a mutual fund liquidating a large amount of its gold mining and gold, silver, other related holdings. This bottom wasn't very long. I thought this would go a little bit longer because bottoms take some time. But what happened is speculators started buying, computer models started buying, and it drove the price of gold up. And I didn't chase it because I kind of thought that it's going to come back down. And here I've said before, here you see a left shoulder, a head, a right shoulder, and this looks like a topping pattern, and we're seeing it undercut the bottom side of its 50-day moving average. This is not a bullish view at all. And then we saw Thursday down move, Friday down move, and that's setting up a move lower. And I've said that we've got a look somewhere around 1240, 1250, and maybe around the low 1200s. And so I showed this chart on Wednesday, I believe. And this is a chart from Peter Brandt. And he's not been posting much on gold, but I love it when he does. And this was that longer term view where we thought it was going to break out of this long 30 or 60 month 5-year channel. And it didn't. It saw selling, and we know that selling came out of the computer models because that's what the people that are managing them reported. And there's a lot of noise going on here that we can't see, so let's zoom in on his other chart. And again, this is kind of the reason I like Twitter, is because you get some cool stuff from time to time. And here's that left shoulder, right shoulder, and you can see prices are headed lower. Now he says, here's what we know, the volume on the charts are wrong. And he's not saying that the volume shown is wrong. He's saying that it's not showing a proper pattern. Commercials have been selling from their December lows. So that's still sold into this rally. So keep that in mind. And the market's in sideways congestion. He says too early to predict, but we're looking closer to a sell signal. And he's right. So if you look at this 1287, according to Peter, if it breaks this, his target would be around 1220. Now let's go back to my chart and see what that looks like. So here I've kind of roughly drawn in his line. It's pretty close to roughly what he's got in terms of breaking down this 1287 level. And where's 1220? Well, it's right here at the top end of this little bit of buying over, looks like about a month and a half, 2 months here. Why is this significant? Because what we're getting a picture of is the smart money wanted to buy more down here, but they weren't able to. So what are they doing? They have been selling since December. So they've been selling all into here because they want to drive the price back down to buy. And that's really cool because bottoms are a process, and if you miss the first bottom, there's like a high probability you get a second chance at it, and it's the second chance is what you want. The first chance usually goes up and comes back down. You see these you hear the term double bottom in markets all the time. That's because markets tend to retest or come back and touch that prior bottom to confirm. That's really where you want to buy. Now, if his charts are right, and the reason I like gold and I like Peter's research in gold is because gold is generally an unmanipulated market. It is probably one of the purest markets that you can chart. And what it's saying and what he's saying is that my research was right, which is really cool. Anytime someone smarter than you says that you're on the right track, that's good. This would send us down somewhere around 1220, maybe a little further. But this would tell me this is where I would be wanting to buy, because his data is telling us this is where the commercials were buying. And they started selling in December into this rally. So here's December right in here. So they've been selling all of this up here. And that tells you that they want to buy right back down in here. And that's where I want to be buying. And that would tell us that gold mining stock should be back down around this $19 range, which is exactly where I'd really like to pick this up, and knowing who bought here. Well, now we know who bought, because he essentially told us it's the commercials or the smart money. They're called commercial hedgers, and they have more information on anything, and they are usually right about the market more often than not, hence their moniker, the smart money. So that tells us that the symbol GDX here is headed down to around 19. Now let's look at silver mining stocks, which I think charts a little bit better. And you can see they're sitting right on top of this resistance zone, looking to break down below they're below their 50-day moving average, about to break their 200-day moving average, and they just closed below their 100-day moving average in blue. And that tells us that they're headed back down to this 23, 24 price range. And that's where the smart money's been. That's where we'd like to buy, because we didn't really miss anything. There should be more selling going into that. So that's pretty cool. All right, so I've got 4.5 minutes left. Let's fly through what we've got. S&P 500 looking like it's going to break out to new all-time highs. I know the bulls like that. So let's try to identify if this is going to break out. And there's a really simple way to look at it. Let's look at volatility. And volatility is getting scrunched nearly down to, it's not at its all-time lows down here, but it's historically at a very, very low point. If we go out 20 years, you can see, I'm going to draw my mouse line, you can see it doesn't really get too much lower than where it is right now. So volatility has been compressed, and in order for stocks to rise, volatility has to continue falling. And the reality is it can go down, and stock prices can go higher. Do not misinterpret what I'm about to say. But when you have volatility crunched down this low and you have stock prices this high, what is telling the smart money is people are already loaded into their stock positions. They're loaded into their short volatility positions. And if you want to unwind and make some money, you should be shorting the market and buying volatility, because the odds of this continuing to go down and break out into some huge rally are pretty low. Volatility needs to release. Stock prices need to come down before a move above the highs are made. And so volatility is telling us that, this probably doesn't have a whole lot more left in the tank. Now, looking at the ETF for volatility, it's crashed pretty much down to its low. Now, it's been lower here, but not a whole lot lower. Again, suggesting there's just not much more room for this to go down, and the likely move still becomes up. Now, look, I thought we were going to get that move here, but sellers came in and shorted volatility, drove stock prices higher. And what's interesting, they're doing this going into this 80% blackout period where earnings should be bad compared to what they were projected 3 months ago. All right, so we've got 2.5 minutes left. Let's take a quick look at oil and gas producers. These should be coming down because of the oil stocks building, but people think reflation is coming. And look, it went up and tagged resistance. I think I said that it might do this, and there it did. And it got some pretty decent volume today as people came in and sold this move. There is going to be a retest of these December lows at some point, and there should be a retest on the S&P 500 of its December lows to validate this move higher. It's just what you get, these double bottoms. Markets like that because it confirms that this was a valid bottom. We have no confirmation of that. So anyone thinking they missed out and the markets are just going to go to the moon, according to volatility, not there. According to oil and gas stocks, no, because again, these things do follow, or stock prices do follow oil and gas producing stocks. And there you go. You see them chugging higher. Here's the S&P. Here's this. This should be up here. So if you're really bullish on the market, then this is the underperforming sector. If this is right, and the oil builds are showing this is right, then stock prices definitely need to come back down. Let's see. We've got not much time left. Emerging markets, I still think those need to come back down. I'm not the only one starting to have that opinion now, that we should see another bottom down here for them. And let's take a look at the ags real quick. We see some nice bullish candlestick here, strong buying all the way into close, and not on really high volume. So it could be that we're starting to see that the sellers are tapped out, and then all of a sudden we should see this next leg of this go higher. So this kind of downward move is actually bullish because it's showing that people are selling, but there's buyers coming along the way, and all of a sudden, boom. Again, we'd like to see this. The setup for this is pretty fantastic. Last but not least, for those worried about the bond market, let's put this in perspective. So we saw bond prices rise, and then they gave back some selling. Now look back over here. We see bond prices rise up to roughly the same peak and sell back down to right here, which we go across. It's kind of right in the same zone. And we can go into other points over here and see where it came over this little dotted line, found some selling, and came back down into, right about where it is now. So there's not a reason to panic, not a reason to get worried. It's just probably the people that bought down here are taking some profits and looking to buy back in again at a lower point. But with the banks still holding as many treasuries as they are and continuing to buy, despite the profits from JP Morgan today. If you look at Wells Fargo, whose big money maker is mortgages, they just printed the lowest number of mortgages since the financial crisis. Now they're projecting in the months to come that number is going to go back up. Will it? We don't know. But the fact that they're originating such a small number of loans now is not bullish for higher interest rates at all. So I'm Steve Van Metre. We'll be back with you probably, I'm assuming, on Monday, barring anything that I don't know. I appreciate you taking time to watch. If you have any questions, give me a call. Send me an email. I'm here for you. Bye now.